Hello students, welcome all my viewers and students to the risk management lecture series 13. In today's session, we are going to cover the following topics related to investment risk. In the previous topic, we have already started the meaning of investment risk. Now we are going to have a look at hedge funds, that is hedge funds, the basics about hedge funds, the working of hedge funds. Then hedge fund strategies, hedge fund risk, eligibility risk, associated with hedge fund. Benefits of hedge fund. We'll have a look at different benefits of hedge fund. And lastly, we're going to see the analysis of performance of hedge fund. Let's move on to the first topic, that is hedge fund basics. What is actually hedge fund? What does the hedge fund the term mean? The term hedge fund originated from the paired long and short positions that the first of these funds used to hedge market risk. Actually, this kind of fund were used to hedge the market risk, and that's why this kind of fund got the name that was termed as hedge fund. But later on, it just changed this form. You can say like mutual funds only, but few differences are there between the characteristics of hedge fund and this. So over time, the types and nature of the hedging concepts that expanded. And today, hedge funds they engage in a diverse range of market strategies and employ a wide variety of financial instruments and risk management techniques. Now, in today's scenario, a hedge fund is an investment fund that seeks capital from accredited individuals or institutional investors and invests in a variety of assets, often with complex portfolio construction and risk management techniques. It is actually administered by a professional investment management firm, and often they are structured as a limited partnership, limited liability company, or similar vehicle, we can say. Hedge funds are made available only to certain sophisticated or accredited investors, and they cannot be offered as sales to the general public. This is the basic difference. Now, let us have a look at the working of the hedge fund, how it actually works, and formation of hedge funds. Hedge funds are actually, we can also say that hedge funds are almost always open-ended, and they allow additions or withdrawals by their investors, generally on a monthly or quarterly basis, and the value of an investor's holding is directly related to the fund net asset value. Now, looking at the working, we see that here the money manager can be an individual who starts the hedge fund. They give proposals to investors for investing their money in a fund that is managed, that will be managed by the money manager. That is, the money manager is going to start that kind of fund. Now, what happens is, what's the objective of that? Objective of that starting the hedge fund is actually continue generating profits regardless of market performance. So whatever is the market performance, irrespective of the market volatility, the objective of this fund is continue generating profits. So the investors are actually given proposal for investing their money in terms. What happened is investors and money manager they enter into a partnership contract. That is a legal agreement where they sign, and through the contract it is assured that the investors will be paid back their money back whatever is the market condition. So you get some amount of profit, a minimum amount of profit in case of uh, you can say that the market is not performing very well. Now, the investors, in return, they have to pay a fixed charge to the money manager plus percentage of a profit. A fixed charge is also there, and then depending upon the amount of profit that will be generated from the fund, they will get a percentage of the profit. Now we see hedge fund versus mutual fund. There's certain differences are there between hedge fund and mutual fund. So what are those differences? First difference is that mutual funds are open to any investor, but hedge funds are actually accessible only to large investors because this hedge fund requires a lot of money to be invested and lots of money. Next difference is mutual funds they face less regulations, whereas hedge funds have some kind of regulations because some other kind of lots of money are involved in the game. Third difference is aggressively managed or used derivatives and leverage in both domestic and international markets with goal of generating high returns. So these are actually aggressively managed and leverage can also be used, derivatives can be used. That depends on the different types of strategies of hedge funds. And they invest in both domestic as well as international markets in order to diversify the funds also. And the goal is actually generating high returns from it. In mutual funds, there is no assurance of returns. So the manager of the fund don't give any kind of assurance to the investor about the returns from the mutual funds. But in hedge funds, there is assurance of return. Now coming to the next topic, that is hedge fund strategies. We'll have a look at the different types of hedge fund strategies. What are those? Our first strategy is global macro. What is this global macro strategy? Actually, hedge funds whenever they are using a global macro investing strategy, they take sizable positions in shares, bond, or currency markets in anticipation of global macroeconomic events in order to generate a risk-adjusted return. Now, global macro fund managers they use macroeconomic analysis, which is based on global market events and trends to identify opportunities for investment that is profit from unanticipated price movement. This is actually what is the global macro strategy is all about. The next strategy is directional. Now, directional investment strategies they use the market movement, trends, or inconsistencies when picking the stocks across variety of markets. For this, the fund manager also use the different computer models. They can use the help of technology today. This types of strategies actually they have a greater exposure to the fluctuations of the overall market than do we can say that it's actually having a greater exposure to the fluctuations. Our next strategy that comes from the hedge fund strategy is actually event driven. What is event driven? Event driven strategy is that they concern the situations in which the underlying investment opportunity and risk are associated with an event. So, uh, like this strategy actually finds investment opportunities in corporate transactional events such as consolidation, you can say mergers, acquisitions, recapitalization, bankruptcies and liquidations and all this kind of events. Managers, they employing this strategy. What they do is they capitalize on valuation inconsistencies in the market before or after such events, and based on that, they take a position on the picture movement of the security. Then we move on to the next strategy that is very popular, that is relative value. Relative value is actually they take advantage of relative discrepancies in price between securities. This can occur due to mispricing of securities compared to related securities, the underlying security of the market overall. So hedge fund managers, they use this various types of analysis to identify the price discrepancies in securities, including like technical analysis can be done, technical analysis, fundamental analysis, mathematical techniques. All these things can be used to find out the relative position. Now we move on to our next topic, that is hedge fund risk. Uh, First type of hedge fund risk that is associated is actually a leverage risk. Now, leverage risk means whenever a fund takes a lot of borrow a lot of money from individuals from the market, then it is actually exposed to leverage risk. If higher borrowing increases funds exposure to changes in asset value, large losses can lead to margin calls from vendors also and redemptions from investors. So both of which is required can require the manager to liquidate the portfolio at higher sale prices. So this is actually leverage risk. Sorry. The next type is derivative risk. Derivative risk is like options must be delivered within a specified time period. We know about this. Derivatives consist of options, futures, swaps. Now, uh, if the options are to be delivered within a certain time period, that is expiration date. If there is a completely unexpected economic event during that period, even if the manager is correct about the long-term trend, he could lose his investment. Our next category is regulatory and transparency. What is this? Now, lack of regulation then may lead to frauds and other additional risks. Hedge fund managers are risk tolerant, as again nothing if the hedge fund collapse, but the investors lose all their money. So this is also a lot of risk to the investors, regulatory and transparency risk. Next is investment risk. What is that? That is redemption risk and returns are not guaranteed. Concentration risk. This type of risk involves excessive focus on a particular type of strategy or investing in a restricted sector for enhancing the returns. Concentrated, the fund is concentrated to any particular sector. So this actually increases the risk. So such risk can be conflicting for particular investors who expect vast diversification of funds to enhance returns in various sectors like that. So, uh, for example, you can say the hedge fund investors may be having a defensive technique of investing the funds in the FMCG sector since it is an industry which is operating on a continuous basis with a large scope of expansion as per the changing customer requirements. So all these things can lead to concentration risk. But this concentration risk can vary from one customer to another. Our next category is performance issues. Performance issues can be that the fund, for a hedge fund fails to perform well. So various factors can be related to the performance issues like interest rate formation, credit spread, stock market volatility, leverage, and government intervention, creating various hurdles that reduce opportunities for even the most skillful fund managers. This can also occur. Next is rising fees and prime broker dynamism. So this is also a risk. Day by day, the fees of the fund managers is increasing. The prime brokers, they are trying to play games with the investors, mismatch or incomplete information. This is actually, you can say, it is the duty of the fund managers to review the performance of the fund on a regular basis. However, the results can be fabricated to match the direction of the fund manager since the offering documents are not viewed, reviewed or approved by the state or any authorities. So, hedge fund may have little or no operating history or performance and hence may use hypothetical methods of performance which may not necessarily reflect the actual trading done by the manager and advisor. All these things may lead to mismatch risk or information risk. Taxation. Taxation is hedge funds are generally taxed as partnerships in order to avoid instances of double taxation and the profit and losses being passed onto the investor. Problem of plenty. Presently, you can say the biggest problem that is faced by the hedge fund industry is the existence of far too many hedge funds are there. So, if an investor wants to multiply his investment and generate a continuous trend of positive return from it, so this it needs to be exceptional regularly. So, you know, there is a problem from this plenty because most of the small hedge funds they are currently struggling with the burden of additional costs being imposed along with rising client operations. So all these things are actually hedge fund risk. We move on to the next topic that the benefits of hedge funds. Benefits, first benefit is that the return is incomparable. Return is huge in this case. Certainty of returns is also given, which is not given in case of mutual funds. Customized service is there. The service that is given by the hedge funds can be customized. Can mean it's not can be, but it's surely customized according to the need of the investor. Their hedge fund portfolio are managed with utmost care, so maximizing return with minimizing of risk. Their handling is done with a proper care and managed properly by the money manager. Managed by a money manager, and there is assurance of return. So these are actually typically the benefits of hedge funds. Coming to the analysis of performance of hedge funds. Analysis performance can be measured through absolute returns. A hedge fund must be evaluated based on absolute returns, but those returns also need to be consistent with the fund strategy. What is the absolute return that we get from a hedge fund? So it definitely is the first measurement of its performance. Next, second one is relative return. That is determines the fund's attractiveness whenever we are comparing it to other investment revenues, other investment funds, you can say mutual funds, certain indexes. So relative return. Next, third point is the very most important one, that is Sharpe ratio. It measures the amount of return adjusted for each level of risk taken. This can be calculated by subtracting the risk-free rate from annualized returns and dividing the result by the standard deviation of the returns. So mathematically, we can state that Sharpe ratio is equal to annualized returns minus risk-free rate, and that should be divided by standard deviation of the returns. If Sharpe ratio is greater than 1, it is an attractive return. Benchmarks. Analyze relative returns versus a benchmark. A benchmark is many a times it is said that this is the minimum benchmark of performance of a hedge fund, and for that the hedge fund should perform up to this benchmark. If below the benchmark, we say that benchmark is actually kind of cutoff. So below this benchmark, we say that the hedge fund is not very attractive, and above the benchmark, we say the hedge fund is attractive. So these are some of the yardsticks that we use for measuring the performance. Here we end today's lecture. The next lecture consists of investment style. We'll have a look about what do you mean by the term investment style. Many a times we say that there is a style drift in investment. So what is style drift? Then we'll also throw some light on the monitoring of the style drift, how the style drift can be monitored, how it can be detected, and then how it can be controlled. Because it's very important one. Many a times, whatever the style of the investment is stated, it gets drifted from its origin path, and that's cause a lot of problem for the investors. So style drift should be controlled immediately, but before that, before the controlling can take place, it should be monitored regularly to find out whether there is any type of style drift in the investment. And after its detection, after proper monitoring is only the detection is possible, and then proper preventive measures should be taken to control it. So that's all for today's lecture. I thank all my viewers for listening patiently to today's lecture. Expect to see all of you in my next lecture. Thank you for today. Thanks.